This episode is presented by Baker Tilly, a top 10 accounting, tax, and advisory firm. Hello, and welcome back to Equity, TechCrunch's flagship podcast about the business of startups. I'm Marianne Azevedo, and this is the episode where we bring on industry experts to help us explore a trend in the tech world and dive deep. It's no secret that 2024 was a breakout year for AI, but to dive deeper into the numbers, I'm handing the reins over to TechCrunch editor on the venture desk, Julie Bort. Julie caught up with Ryan Hinkle, a managing director at Insight Partners, a global venture capital and private equity firm specializing in high-growth technology and software companies. Let's give it a listen.
Hello, Ryan. Welcome to Equity.
Super psyched to be here. Can't wait to do this.
Before I start asking you about your somewhat controversial opinions about New York versus the rest of the country versus Silicon Valley, can you tell me a little bit about yourself, your career? You know, I heard something sort of amazing about you, that you started as an intern at Insight Partners, which is a massive VC firm, like 90 billion assets under management. You just raised another 12.5 billion. So tell me a little bit about your career and the key deals that got you to be this high partnership level you're at.
I think we're aiming for 30 minutes. I could do the 3-hour version pretty easily, so you'll have to keep me on task on time. But the shortest version I can tell, unfortunately, it still starts before I was born. And this will make sense in a second, I promise. But my grandmother started a clothing store in 1969. I was not yet alive in 1969, full disclosure. By the time I was conscious and aware, my grandma's store became a 15-strong chain of independent specialty retail. And my dad worked there, my mom worked there, my uncles worked there. Every Sunday, family dinner was really more of an operating meeting or a board meeting. And I was witnessing through the eyes of the child what entrepreneurship looks like. And I also got to witness what catastrophic failure looks like when big box retail encroached and ultimately choked specialty retail, including the family business and identity, right at the moment that I was going into paying tuitions. And so here I am, kind of junior year of high school, family identity wiped out, lots of turmoil, mom's laid off, dad's laid off. You can imagine what that felt like. And I didn't really know what I wanted to be when I grew up. And I pursued a program at Penn called the Management and Technology Program, where I got an electrical engineering degree in one hand and a Wharton degree in the other hand, and still didn't know what I wanted to be when I grew up. And I met Insight through the summer internship program, where all of this backstory started to fire in synapse and just speak to me, because Insight's in the business of providing capital and capability to great business models. P.S. Retail is not a great business model. Software is the best business model. We'll talk about that a little bit later. But to work in a great business model, providing capital and capability to fully fulfill the wishes and dreams of the entrepreneurs and the management teams that make it happen, spoke to me on just a personal level, given the family history.
But even so,
go ahead.
A lot of interns come into VC and they don't make it. What was the key moment that had you climbing the ladder at this giant company?
That's part 2 of the story. So I got into this 10-week job, assuming it was a 10-week job. And you talked with very flattering, we appreciate the kind words about what Insight is now. Insight was not that then.
No.
When I joined Insight, we had raised a cumulative $1.2 billion ever across 4 funds. We had put only $750 million of capital into investments at that point. We do more than $1 billion per quarter today. So it was a 10-year-old firm. And in all of those 10 years, $750 million invested, which is that's like a good month for us today, just to put it in context. It wasn't hundreds of people. The entire firm had 33 people. And I remember this because when I explained to my family that I was not going back to a bulge bracket investment bank, but instead going to a 33-person company, I said, because I like the idea of being 3% of the workforce. That's how it just sticks in my head. So I was with the same colleagues that are the top 4 IC positions. They were all there then. And they were teachers, mentors. At the time, we had partners and analysts. And as the firm was growing, we needed kind of a middle as well. We couldn't just have the top and the bottom. We needed a middle. And I was well positioned based on passion, capability, and enthusiasm, and was able to create and fill that space as we've now built out a 400+ person firm, and was just, I don't know if luck is the right word or smart enough to see the luck or what, but I seized on it and fell in love with what we do, which is as I said, helping fulfill the biggest, boldest dreams of the best entrepreneurs on the planet.
So just rattle off for me then some of the key investments that you made that sort of made your stake at the company? Pluralsight, I'm seeing, Chegg is another one on your bio, but you know better than I do. Which ones are the ones that sort of made your name?
Sure. I mean, I was a part of the team when we invested in Twitter before billion-dollar valuations were like cool. If you look up the press in 2009, it was coming out of the ashes of the financial crisis. And we did the first billion-dollar plus round for that company. It was a fairly contrarian bet at the time because there was still a lot of scattered turmoil from
Yeah.
But even at that point, there was that race between CNN and Ashton Kutcher to be the first entity with 1 million followers. It was a big deal. And that was April of 2009. So it had hit mainstream kind of mindset. But how do you make any money out of it? And that was an important moment. And yes, Pluralsight, Smartsheet, some IPOs that I helped make happen. And I mean, God, there's dozens and dozens of great stories to tell. I'm sure we'll hit a couple more.
Awesome. With this long history, you've seen a lot. Well, the last time you and I talked, we kind of got into this discussion. I think you disagreed with me, but I would like to hear it now. Is that, over the pandemic and shortly after the pandemic, everyone was like, Silicon Valley's dead and no one wants to be there. And New York's the place to be. And I talked to so many founders who were like, we're going to set up shop in New York. And then OpenAI happened, or rather ChatGPT happened. Silicon Valley became the center of that sort of universe with OpenAI there in Cerebral Valley. Now I'm hearing from founder after founder that are saying we are moving back to Silicon Valley or relocating there or jointly locating there. And you said you don't think Silicon Valley is the place to be for founders, that they need to take a look at other options. So tell me a little bit about that opinion.
Yeah, it's not anti-Silicon Valley.
Okay.
It's just not the only answer. And it's important. And I took way too much math class in the journey. You heard some of that story earlier. You don't get an electrical engineering degree with lots of math class. And there's a concept of necessary and sufficient conditions, meaning that it's the only way something works. And I'm just saying Silicon Valley is not a necessary and sufficient condition for success. It's just one option. And when you think of what you need as a company operating, you need access to talent. You need access to some degree of loyalty to your company, and you need success at that company to create the retention of the employees. What Silicon Valley gets out of box is a nearly limitless pool of talent to draw from. Unfortunately, that talent tends to be very expensive. And it's not like you're the only game in town. So a hotter, faster growing company can attract your best talent far more easily in Silicon Valley than in, say, Tulsa, Oklahoma, or Omaha, Nebraska. And so the best place for your company is wherever you are, provided, of course, you can get access to that talent that you need to continue driving your company. So sales teams tend to end up bi-coastal or with multiple locations because you want salespeople near the customers. It's really, where do you build your product team is the heart of the question on Silicon Valley versus not Silicon Valley. And with the OpenAI/generative AI revolution that is happening right now, access to AI-capable resources is clearly on everybody's minds. And the university systems are churning them out. Stanford, of course, being the epicenter of Silicon Valley is one example. But you're getting it from MIT, and you're getting it from Georgia Tech, and you're getting it from Carnegie Mellon, and you're getting it from University of Texas, and you're getting it from all the schools in Salt Lake City area. So it's not limited to a single city. It's a talent question. And wherever you can get loyal, effective, and affordable talent, that's the right place for you.
And you feel like talent is not necessarily as loyal in Silicon Valley. That's almost an ethos that it isn't.
It's close to mercenary. And I mean that with love and affection. I don't mean that to sound like a negative word. People have correctly figured out that there is a finite number of company journeys you can have in a single career. And you think very carefully about what 3 to 5 year chunk I'm committing to in a company. And when everybody believes in that company, it's great. Oh, the stock's going to be worth whatever, 15 times, this appreciation. But when there starts to be a question as to the value of that company, there's 3 companies in your building probably that are seeking exactly what you're providing. And it's easier to look to the left and look to the right when you're surrounded by so many opportunities. So I do think the retention challenge is uniquely hard in Silicon Valley because the just absolute abundance of companies that exist.
So what other ethos differences are there between New York, where you've spent most of your career, and Silicon Valley? Like when I talk to founders, I just feel like everything is different. Like their orientation, the way they talk about their companies, the way they manage money is different in New York than it is in Silicon Valley, where not only access to talent is abundant, but there's a bazillion VCs and all that kind of stuff. So have you noticed a difference between companies that build in New York versus those that build in Silicon Valley in other ways?
Yeah, but I think New York is its own special case for kind of non-Silicon Valley thinking. New York, I would argue, is also not an ideal place because just your allocated rent is 3 times bigger than anywhere else in the country. And Jersey City is just across the water. It's half the price for allocated rent. Again, what do you need in your headquarters? If you're selling to large banks, it makes tons of sense to be based in New York because a lot of your customers are there. But if you're running a consumer internet company, like the worst place to be is in the heart of the most expensive real estate in the country. So it's what is the point? But I'll draw the distinction between Silicon Valley and access to capital and everywhere else where the VC community is not as dense. We talk a lot in finance circles about the grow at all costs versus efficient growth. I don't love the suggestion that we literally were growing at all costs, but I understand where that comes from. Where it comes from is this idea that I can try and fail and raise more money. That's really what grow at all costs means. Like, why not try? Because if I'm successful, I'll have a better outcome. And if I fail, I'll just raise more money. That mantra exists more deeply entrenched when you're surrounded by capital. And when you're not surrounded by capital, there's just a slightest bit more fear of if I run out of money, that's the end of the runway for me. If I can't get more capital, I have a business failure risk that I don't like. And it's that distinction on capital availability / conservatism that tends to dominate the big divide between a Silicon Valley mindset and a non-Silicon Valley mindset.
Well, what part do the VCs play? I mean, I've heard over and over from founders, founders' biggest fear is that their board is going to fire them, right? So I've heard over and over from founders that the VCs whisper in their ears, that the VCs on their boards give them the growth at all costs, that the VCs are looking for the next round as opposed to always building a sustainable company in a slower way. Not all VCs. I don't want to, of course, there's a lot of great ones out there with great business experience, but what part do they play in that mindset?
It's a great question. And this is where that story of watching my dad and my mom and my uncles and my grandma just toil away and watch the family identity get crushed, where I have the deepest empathy for the fundamental principal agent divide between we, the investors, and companies. We have a portfolio and we can afford a zero because there's X more other companies that offset that. An individual, a founder, really can't. I mean, they can do another company, of course, but you're gambling with their livelihoods. And I believe that the purest VC mindset to dream big and have an ethos of, if I can describe it's possible, it must be possible, let's go fund it, is only possible when you're playing portfolio theory. And so I think that friction that can be felt between a VC group and an entrepreneur is consequence of failure is radically different for the entrepreneur. And my suggestion, solution for that is just open transparency. Just have the discussion of time out a second. Like, I know you want me to go this way, but if it doesn't work, I need a safety net besides game over. Like, that's not...
Like, negotiate before you agree to the next round.
Well, don't do the thing that if you run off the cliff, there's nothing to catch you. And I would take this, we still need a good name. I'm going to push the journalism community to help us. Like, we know the kind of GFC has its cool little acronym and the .com bust has its acronym. We don't have one for this COVID come down great reset. We call it the great reset. But in that, there's been a complete recalibration of what the expectation is on capital. And I think it's a super healthy thing. And I still want to grow at all reasonable costs. And it's the introduction of that word reasonable that's really changed the current mindset for boards and for companies.
Is your tech company prepared for the fast-paced changes ahead? Baker Tilly is a top 10 accounting firm that specializes in serving technology companies with deep knowledge of the industry and a coast-to-coast presence. From tax and advisory to audit services, they know what it takes to overcome obstacles and fuel growth in today's marketplace. Baker Tilly is dedicated to helping you lead the charge, unleashing innovation, unlocking new opportunities, and powering long-term success. Ready to take your tech business to the next level? Go there with Baker Tilly. Visit bakertilly.com/technology.
If you love equity, you'll love Trapital, the podcast that's home for the business of entertainment. Each episode, Trapital host and founder Dan Runcie is joined by experts who dig into the strategy behind the media and technology that drives our attention. You'll hear them explore topics like YouTube's growing influence, the never-ending saga about TikTok's future, and how AI is shaping the music business. Media is one of the first industries to get disrupted. It's Trapital's job to keep you ahead of the latest trends. You can listen to Trapital wherever you get podcasts. That's TRAPITAL. Enjoy.
Some VCs, I just wrote a story yesterday, but we won't name names, are already seeing warning signs that we're heading into another, what I've heard termed greed cycle, right? So VCs, like it seems to vacillate, right? AI is driving this, and that there's a lot of really not great deals happening. Like companies are raising billions and billions of dollars and using all kinds of fancy financial manipulations to do that. SPVs, special purpose vehicles, where they're selling layers of stock as opposed to just buying into the company. I mean, are you seeing that? Like, I feel like there was a great reset, but we're already on the edge of another cycle of maybe unqualified optimism,
But it's bifurcated. There's really the AI companies and then everybody else. And the everybody else bucket, the basket of SaaS stocks that is most kind of the insight world, is still 30% lower on a multiple of ARR basis than 2019. Forget the 2021 bubble times.
Yeah.
Like it's 30% lower than 2019. Now, the stocks are up because the company's revenues are up a lot, but the multiple of revenue is still lower. So if you're outside of the magnificent, what's the number these days, 6, 7, 8, whatever the number is, and you're outside of AI, we're still at a reset level. When you look at AI, it reminds us in some respects to the .com moment where it was crystal clear the internet was changing everything, but it was not crystal clear entirely how. And a lot of the AI, even the foundational models, they're selling gross margin negative products. We know that can't work forever, but there's some of them building these massive consumer brands, and that's clearly got some value. What's hard to understand is exactly when and how the revenue models will mature and turn on across all of these models. Some firms are certainly just convinced they'll figure it out quickly, and they can make $50, $100, $200 billion outcomes happen quickly. Other firms are thinking about how to apply these technologies into their existing portfolios to make more effective products for their customers.
But the upshot is we're standing at a moment where there's big deals happening, but people, they have figured out in some ways how to make revenue, but not profits. Like this is just still a very expensive thing.
But it's not even gross profit.
Gross profits.
This is important.
Yeah.
I can go sell $10 bills in Bryant Park right now for $5 a piece. I can just explode my business up. So you give me $5, I give you $10, and I can make massive revenue gains. The gross margin is the place that I would keep everybody's eyes focused. We have no problem as a franchise, as a firm, investing aggressively in sales and marketing. If you don't have the gross margin model at least contemplated at some point, that's where it gets tricky. And a lot of these major outcomes don't have gross margin positive solutions just yet. And so we're curious where that evolves. And we're unlikely to be the firm with these massive checks at massive valuations, but we're deploying these technologies across literally hundreds of companies from the inside of how do you make a better product? How do you get more efficiency? How do you build a better customer intimacy? That's our obsession right now in this AI moment.
Oh, interesting. So you'll see it from a customer point of view and know when to invest. I mean, Insight's known for writing really big checks into companies that it sees potential in. You're not shy about that. But you have said that sometimes you're just shocked because you're ready to back a company and you ask for financials. You're asking a bunch of questions and the founders can't provide you with those questions. Can you talk a little bit about the hindrance that founders face from getting a big check from you when you're trying to figure out if their company's worth investing in?
Yeah, I don't think it's just an Insight phenomenon.
Sure.
I think that the reality of hypergrowth is nothing is the way you really want it to be from a systems perspective. And you're faced, and I have empathy for this too. Do I want to double my revenue this year? Or do I want to stay flat and have perfect systems? And guess what? Every single time, I'll take the double and I'll figure it out next year. And then next year, they're faced with the same choice. Do I spend the time this year to fix my systems or do I just double again? And we usually get involved with a company about the moment where you can't not build a system. Like you really need a CFO, you need a financial infrastructure, all of the transaction database to be much, much clearer and cleaner so you can track and measure all of the levers that drive your outcome. And I think it's chronically underinvested, including after we get involved, because we too are intoxicated by the same get the growth. Why should we slow down to optimize? And our general mantra is to fight that urge and to always be thinking about someday you'll be 100 million or a billion or whatever the next milestone might be. Let's make sure we're building an infrastructure befitting that scale in real time, not regretting not doing it because something breaks.
So what are some of the questions that a founder should be able to answer about their business at the point that they're going for, I don't know, a Series B, something growth-like, where they're not just waking up every day and putting out fires? Let's just say Series B. What kinds of questions should they be able to answer about their business?
Can you produce for me an anonymized customer record of all transactions with each customer? Again, I don't need to know the customer names, but an anonymized record of all customers since beginning of time.
Mm.
And while that sounds like maybe a big ask, it's really an invoice register with a little bit of contract detail. And if that takes more than a button push, the question is, okay, where is it all stored and why is it potentially scattered? What we often hear is we have an invoice system that's separate and distinct from our bookings machinery, like where I book, and I don't keep track in either of those systems my contract durations. It's yet another system that I have to enter, and they're not perfectly in sync. They're close enough, and there's no radical error, but to do cuts and manipulations is quite hard. And I totally get it. When you're growing 100%, like, spoiler alert, the metrics are good. Like, I know that. So what do I need to care? But when you start to see invariably something changes on you, you have a competitive encroachment, or you're not able to double your new business every year, all of a sudden you've got to refine the sales math now and the unit math. And if you can't see it, it's hard to know which levers you're affecting. And that's where I'm borderline pedantic on this, just obsessive over how do we at least see it.
Do you support like a CFO position being one of the positions at like the seed stage? Because I would say most VCs are like, you don't need that yet. You're just trying to find product market fit, blah, 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 and yet if you grow really fast, then what? Do you support that?
I think there's this misnomer that you need a certain 3-letter title to be able to implement these types of systems. You just need someone to sit down and make sure, and it could be the entrepreneur themselves could do this, where you get from quote to cash. I quote a customer a thing and I get cash. What are all of the steps? And is every one of those steps tracked in some system that talks to each other? Or is it 3 different individuals hand entering in 3 different systems? And I don't mind if you're small and do the hand entry, but can you try to do yourself a favor and make sure there's at least a unique identifier, like a contract ID number or a customer email, something that helps you stitch these tables together someday when you put them into a database. I don't think you need like a perfect accountant to do that. It's just, in database speak, it's just a join. You just need to know the join. And the easiest time to do that is when the database has very little records. Once you have tens of thousands of customer records, it's really hard to then fix that for all time. And that's what I'd love to help you avoid.
And something like that is the difference between getting your dream valuation or a check or a giant VC to back you and not, right?
Yes.
It's sort of almost the little step, because you guys have to investigate the company. You have to do your due diligence. And if you can't get answers to this,
yes.
Yeah.
There's a company right now, I won't name it. I won't even say what space they're in. And if they're listening, hopefully they hear the love I have for them. We love the company. And there was a stated point of view on the retention rate of the company. And we were having exactly this challenge getting the data.
The customer retention rate.
The data that we can then use to derive retention. And every time we got a data cut and we ran it, it was 20 percentage points worse than the feeling that the CEO had. And he was convinced, and he's probably right, that there's a data problem. But that creates a big problem for us. Like, we can't hold the risk that it's really the data is right and the perception is the problem. And so we committed to say, we will spend any amount of resource we have to. We will literally hand code this for you on an invoice by invoice basis, because we would like to solve this for you. And we don't believe this is an Insight limitation. This is your company limitation. We'd love to be able to help you through this journey. By the way, the answer is not necessarily a CFO. It's just tackling the beast. It's only 30,000 records, which sounds big, but it's not that big, especially with AI tools and everything today to play with it. So those are the types of discussions that we try to cultivate. Like, we want to help make this better for you because we believe you, but we have the due diligence burden of proof, and we'd like to prove it with you. Does that make sense?
I don't think a lot of founders understand that when you're partnering with finance folks, then the finance of your company is just as important as all the exciting stuff, the new product that you have, the new feature that you managed to figure out, the growth revenue numbers that you can throw at. It's all the rest of the stuff of running a company that's going to be just as important. Maybe not as exciting, but just as important to getting a top name VC to back you.
And we're still in this hangover, aftermath, great reset, post-COVID come down, insert fund names here, where a lot of us were badly burned in the COVID era, where demand signals were very temporal. They shifted badly on us. And so the desire to triple, quadruple, and quintuple check is as high as I've ever seen. And what used to be a mantra of, if you can paint me a picture that it's possible, I'm likely to believe you, has shifted to, if I can't see it with my own eyes, it doesn't exist. And so that burden of proof is extra important right now as the investor community that gives VCs money, the LP community, they expect this, like, it can never look like that again for any of us. And so the emphasis on these metrics is heightened, and I suspect stays heightened as the due diligence burdens have increased for all of us.
Well, we're just about out of time, but where can our listeners connect with you online?
The Insight channels are great channels. A lot of the topics we've touched on today have come out of my own LinkedIn channels, where we talk about the IPO markets. We talk about the importance of unit math. We talk about the Great Reset and what it means. I put out my love letter to Insight a year ago. It was my 20th anniversary, made a big deal of it. And we are putting out a ton of content, particularly our on-site team, which is trying to deliver on the promise of adding value by being everywhere you need as an emerging startup, wherever you might be in the scale-up journey. So I would just point you to the Insight broad channels as phenomenal resources. And there's plenty of ways to engage with us if something piques your interest. And I'm not hard to find. I respond to emails and links, and I would love to engage with anybody listening.
Great. Thank you. Thanks so much again for joining. Equity will be back on Friday. And until then, listeners can keep up with the show at EquityPod and on X and Threads. Bye.
Equity is produced by Theresa Loconsolo with editing by Kell. We'd also like to thank TechCrunch's audience development team. Thank you so much for listening, and we'll talk to you next time.